Hello and welcome back to Core Finance. I'm Matt Brown. I'm joined by Marc Ostwald, who is a strategist at ADMISI. Good morning to you, Marc.
Good morning.
Right, let's talk about the global markets, global economy. Are we heading for recession?
Apparently, according to some people, there are signs in all these yield curves, particularly the U.S. yield curve, that we are, which I find understandable. However, I think there are a number of aspects of why the U.S. yield curve is flattening quite so sharply, which have a lot to do with the constellation of monetary policy and where the global economy is at the moment, and secular trends related to the downward pressure on prices from things like technology, from globalisation, which people are not accounting for, and to draw this conclusion that we're actually headed for a recession maybe in the next 12 to 18 months is probably the wrong conclusion to jump to. So I've brought a bunch of charts along with me. So there we are. There's that US 2-year, 10-year spread over the last 5 years. We are at the low, basically. We were marginally lower 1 point last year. Now, there are two things which are driving this. Obviously, at the moment, and in contrast to where we were this time last year, we've had 3 Fed rate hikes. Now, this time last year, we were actually looking at that scenario of that very flat yield curve as being more to do with the inflation outlook and the Fed not needing to move on rates. In the meantime, obviously, the Fed's hiked rates 3 times, intends since December, and intends to go again in December, or at least that's the message they're sending us. So it is a slightly different combination of, or different constellation insofar as what we're getting at the moment is the short end of the yield curve rising and the long end basically staying stable. So it's slightly different to where we were this time last year. But if we go on, we've also got a situation where you start to look at that table. Now, the only places which you're looking at, these are 10-year yield spreads. These are the returns you're generating by investing in government bonds. And you look down there and you see, oh, well, yes, there are some 4s and 5s and
Brazil and Greece.
But unfortunately, they look like they're Brazil, serial defaulter Argentina, even Mexico at 3.5. Greece, obviously, we know deep problems. So there's barely anywhere where you can generate more than 3%. So that also is something which is driving people up yield curves because they need to generate something in the way of returns. Because as one fund manager friend of mine tells me, he said, we may have been in a 0 or close to 0 rate environment for a very long time, but believe me, when anyone comes in the door here, and I'm managing a bond fund, remember, not an equity fund, and we're not a hedge fund, we are just a traditional long-only investor, they expect returns of 5 to 10%. Well, where are you meant to be getting those other than taking high-risk bets like Argentina?
Well, and even corporate bonds and the high-yield bonds. We've seen this chase for yield that people are going after issuance that really is quite high risk but low yield.
Yes, exactly. And so, well, there is another assumption in here. So, part of that reach for yield is driven by people pushing up the yield curve because they just need to generate some sort of return on their assets. But there is another aspect to it, and that comes on the next chart. This is the US 10-year break-even inflation rate, which is basically the difference, or the break-even rate of inflation you need to achieve a return on US inflation-protected securities versus conventional securities.
Understood.
And as you can see, it's 1.82% at the moment. That's slightly above where core inflation is at the moment, but not much. But basically what that's telling us is markets expect inflation to remain very low for a very long time. Now, I think there is good reason to doubt that.
Yes.
And that's really where the constellation of risks lie at the moment, because we are assuming that inflation is going to be very low. So the risk here, I think the important point when you go back to those government bond yields, and I don't want to go back to the table, is that it would only take the markets to be wrong on inflation, say by about 50 basis points. Now, if you're in
which is quite a small margin.
It sounds small, But if you're actually in 10-year yields, you've got 2.3% and you're wrong by 50 basis points.
That's a big percentage.
That is a very, very large percentage of your returns which you've got wrong, you've misread. And this is where the risks to market lies. If we go on to the next chart, you'll also see why the US yield curve is also flattening, because the next two charts are the spreads between US 2-year yields and German 2-year yields, and German US 10-year yields and US 10-year yields. And one of the things which is pushing down at the long end there is the fact that you've got such a huge premium relative to what you're generating in Germany, that people are looking at US Treasury yields and saying, well, I've got to have some of that because it's so much better than the 0.4% I'm getting in Germany. So that it's a relative attraction. It's not actually expressing a view on the economy. It's basically saying, with that sort of premium, I'd be an idiot not to be invested in US Treasury. It doesn't say anything about their inflation outlook. It doesn't say anything about whether they're expecting a recession. It's basically just trying to generate some sort of return. The story gets worse when one starts to look at at the next two charts. First of all, this is the emerging market bond spread. So we are back at the lows.
Yes.
This is emerging, your premium on average for investing in emerging market debt is 303 basis points. That's pathetic, because if that's that basically means the average yield is somewhere in the high fours. This is for this includes countries like Ecuador, which sold debt yesterday at 8.875%, like Argentina, where the average yield on 10-year US dollar denominated debt is 7%. This country has defaulted so many times it's not true. But it's exactly the same story. It's people chasing down returns. And the pressure is there. A lot of it is basically just get me something with a return. There is no view on emerging markets being really a much better investment in the long run, that risks have been banned. And you see it also in the high yield bond market. We are basically almost, again, at the lows in terms of the average yield. And these are high risk companies. In there, you've got companies which are either in the energy sector, they're small producers, their oil fields may work out, but they're heavily borrowed in the first instance. And say, for instance, in the oil sector, they definitely need oil prices higher than they are now to ensure that they can just meet their debt payments, let alone generate a respectable return. So the fundamental message here is that yield curve is not telling you about a recession. It's telling you that we live in an era of financial repression. And I think it's something which people need to bear in mind, because as much as there could be an accident if people are actually making the wrong assumptions about inflation, and again, I emphasize, not rip-roaring inflation, but inflation being out by 50 basis points, we'll have to have a correction, but we'll still be in an environment which is financially repressed. So you may see a very sharp spike in some of these things, because these are very, very crowded trades, as all those charts are saying. But thereafter, you'll probably see people rushing back, and people will be going, I thought we've just made this mistake and learnt our lesson. And the answer is probably not, because interest rates will probably stay at lower levels, but not at current levels, for quite some time.
Understood. Mark, very, very insightful. Please check out that video and watch it again. If you have any questions, then please post some comments. Lots to digest, but I think it was very, as I say, very insightful. Mark, thank you so much for coming on today.